Hello and welcome back to another day of charting. My name is Justin, and today we want to know whether or not it is time to dump big tech because the NASDAQ 100 is down by $4 trillion just so far this year. And that is only the NASDAQ 100. That does not include anything else inside the S&P 500. So as we look here at the heat map, and I'm going to sort this by no sector or no group, and I'm going to do that because what I want to point out here is that a lot of these stocks are meeting the big tech. Again, like we talked about, is it time to dump big tech? Well, people are selling first and asking questions later. We can note that, again, $4 trillion has been deleted so far. And a bear market is defined by 20% off the highs. So far, year to date, the tech companies which are now down by more than 20% include Microsoft down by 22, Google down by 21, Amazon down by 36, Tesla down by 30, Facebook down by 44, NVDA down by 44. And what else have we got here, right? Pick a name. Adobe down by 33, right? CRM down by 36. The only one which has not quite joined the party yet is Apple. And I think that it's almost inevitable now that if we're going to continue to go lower, that Apple is going to join that club. So again, I'm not telling you to dump big tech. I'm telling you that other people are already doing it. And when we look at year to date, it's indiscriminate selling, right? What's green is what you would expect to see in a defensive market. Things like energy, things like healthcare, things like utilities, and that's about it. Everything else is red. I'm talking big old red. This is a little bit sobering as well because the market took a fresh leg down, but had the potential to go higher based on CPI, which again is Consumer Price Index or inflation. The headline number, which has 3 stars here for the most important number, is core CPI, month over month, meaning prices in April versus the month prices in March. And what we can note here is that prices increased by 0.6% when the consensus was 0.4. And this is also twice as much as what we had in the previous period at 0.3. So this is the most important number, and it's a beat. It's a 50% beat versus the consensus, roughly, and it's 100% higher than the reading we had in March. So it's really hard to tell whether or not we are actually at peak inflation. If we're not, there's likely going to be more value compression, and we're going to be going lower. So core CPI coming in at 6.2 is a little bit higher than the consensus, but it's also lower than the previous reading. Same thing with with CPI at 8.3 versus 8.5 on the previous reading, but 8.1 was the consensus. So I'm not sure if inflation's peaking, and this is very concerning just because, right? James Bullard today was talking about how, I think I can actually just pull the tweet up here really fast. He just spoke just after the market closed. And this guy is basically Jerome Powell's little guard dog, where he goes out, he starts saying all these things and blah, blah, blah. So here he's talking about how we have to go even higher. So this is concerning because, right, as early as yesterday, we were hearing that, right, the terminal rate or where the Fed wants to be is between 2 and 2.5%. Bullard feels goals should be 3.5% on Fed funds rate by the end of the year. So we're at 0.75% right now. We go 3.5 minus 0.75, which means that we have to do 275 basis points in hiking between now and December. How are they going to do that when there's only so many meetings left? We got 1, 2, 3, 4, 5 meetings. So if we take that 2.75 and divide it by 5 meetings, we have to go by minimum, right, 50 basis points at every single meeting between now and December. That's what the market's repricing. It's repricing, oh my God, maybe we are not nearly pricing in nearly as much inflation as we need to. Not only that, again, they're talking about going above the neutral rate. So what does that mean? It means whatever the inflation rate is on a smoothed out basis needs to be lower than where the Fed funds rate is. Fed has to get rates above neutral to move prices down. Oh, geez. So 3.5 might not even be where we finish. Trying to keep the video a little bit tighter and, again, just tell you the story and what is actionable. So if you're trying to understand why we were up in pre-market and then got the huge dump and then pumped up and sold off for the rest of the day, we'll go through that on the technical perspective. But the market's repricing. It's that simple. It does not appear like there is enough selling, which has started. And now that we're seeing all these trillion-dollar companies join the party, it's very hard to say that the path of least resistance is up. It appears like the path of least resistance is lower. And again, this is from David Kostin, May 9th, from Goldman Sachs, talking about how Goldman's cost and sees stocks downside even if recession is avoided. As a reminder, we've already had 1 quarter of contraction, which means that if next quarter, meaning the next quarter that comes out, is also a contraction, that's a technical recession. And they're talking about how the best case, let's read from the top. The outlook for U.S. stocks isn't particularly bright, even if an outlook recession is avoided, according to Goldman Sachs' chief strategist. The best case scenario is for the economy and eventually equity prices probably involves a continued period of constrained equity market returns. This means sideways is the new up. That's right. Sideways is the new up. And down is the new down. Mr. Red is here to stay. The strategist led by David Kostin wrote in a note to clients, risks around equity valuations are skewed to the downside, even in our base case, non-recessionary scenario. Oh no, it appears like the Fed might induce a recession, and that is not good for us as people who buy stocks to make money. What's also very concerning is that as we look over here to, again, the different indicators that I'm watching here, S&P down by 1.6%, QQQ down twice as much, 3%, tech leading the decline. Dollar up, VIX basically flat, still above 30, TNX red, oil up, gold up. BTC and Ethereum down, right? We saw that UST thing today. Oh my God, right? Crypto seems like it might be done. Bitcoin's below 30K. Ethereum's hovering just above 2,100. Doesn't look great. Apple leading, not even leading the decline today, only down 5%. Tesla's leading the decline, down by 8%. But every trillion-dollar company, excluding Google, is down by more than 3%. Most of the ETFs are excluding energy and utilities are also red. So now let's try to understand exactly what's happening. We're now on our 5th week of selling, and it does not really look like the selling is going to stop. So as I zoom out here, again, this is a pretty sobering chart as well. Whoa, is that a megaphone? Oh, jeez. Justin, why you got to do me like that? I'm trying to show you that the playbook is changing. And as bearish as I was, I'm not sure I was actually bearish enough. I still think we have to wait for the reaction to 384, which is going to be 20% off our all-time highs. And what we do from there, I don't know. What I can tell you is that the price action that I'm seeing on the daily chart is a preview for how we're going to close out the weekly. And what I've been noticing is this. So here's the day where we had Jerome Powell, right? Let's actually delete everything. I'll make a couple notes on the chart so we can understand what's happening with SPY. So looking here, right? Jerome Powell, right? Oh, we're not doing 75, only 50. Market's like, oh my God, relief, right? Biggest day in quite some time. And then we get a gap down and a flush. If we were going to form another white soldier, this is our day to gap down, pump up, and claim the 50 and start resuming higher. The market actually did not accurately price what was wanted. Again, Jerome in his prepared remarks said that basically I want the market lower. And then through the Q&A is where he started to talk about how actually maybe this, maybe that, market got confused. So what's more telling than the actual move that we got here on the actual day of the FOMC, it's the follow through. So if we were expecting a trend change and we had all the warning signs here, right? Increasing volume, right? A hammer, continuation, a big old pump. And then the fact that there was no follow through after this period, that's a bigger, right? That's a bigger clue to us than the actual price action leading up into the FOMC. It was a sell the rumor, buy the news, and then fade the move. And what I want to point out here is just what happened post this day. So we sell off hard, we gap down within the range, get a doji, which means if we were going to reverse back up, that was the chance. We had a stabilized price here at roughly 411, which was our yearly low. And then we put in a new low after the FOMC. So don't fight the Fed, and they want things down right now. They want it down. So now as we think about, okay, now we gap down on the next day to this previous range, and what have we done since then? High, lower high, lower high. And what's really telling to me is the candle from today. So the candle from today shows me that the high that we got to was 404.05. And what was the open yesterday? 404.49. We got within 0.1% of touching the opening price, and people just sold. And the reason for that is because some people are willing to take 70 cents on the dollar, 80 cents on the dollar, 95 cents on the dollar, and then shorts want a position. That's what happened. We couldn't even make it to the real body. We sold off. So now if we add over trend lines back in, why is this important? Well, it's important because people are folding on daily candles. And we have to remember that, we talked about this yesterday, there's that $1.1 trillion in inflows year to date, which is come in at roughly 428. So if people are folding at 405, how are we going to get to 428? There's $1.1 trillion, which is trapped here. And they're pretty red. So they're pretty red because right now we're down by about 8% on 1.1 trillion, right? That's about $100 billion. They're going to want their money back. And that same issue that we had on the daily chart is likely going to happen here. We already see it, right? Comes down, comes back up, sells off once. What do we got? 42964 is the high. Next day, 42966. It engulfs it, but that's a double top. Boom, right back down. Why? This liquidity. They're taking it. They want to get their money back. Can't really blame them. So if we're really struggling at 405, and here we go. So we're looking at 405. 405 basically just gets us back inside our channel. We failed here. At the open, we got to roughly 404, and we rejected off the lower blue line. So volume is actually dropping off, but that just means that it's still an orderly decline. It's not good. We're now respecting a new trend. We broke bearish. We're going even lower. So all I can say is that the path of least resistance right now appears like it's down. And where I would expect to find buyers, not where we will find buyers, is in this 380 range. I would expect we're going to get some short covering. We're going to get a dead cat bounce. If it's going to lead to more, we have to get back above our monthly low. And as a reminder, that's 411. So that area on the daily that we just rejected from is pretty easily summarized here by the pink box. This pink box shows us that the dip buying that's been happening since December, again, they're all red now. And that's a perfect rejection off the green line. What we need to reclaim to actually break back bullish. That also happens to correspond with roughly the price that we saw that $1.1 trillion in inflows year to date. So again, we're pretty close to support here, right? Only off by about $8 more. So, right, let's get it out of the way. That's what I think. So there we go. We can also note that SPY and QQQ remain to be coordinated, which means that this is still an orderly sell-off. It's just getting redder. That's it, right? 291, 392, it's within $1. And what we have to remember is that if the share price is only 300 versus 400 on SPY, every 1 point decline is going to hurt it by a third more. Why? It's worth 300, not 400. So it's going to hurt it more. And that's what we can notice here. All right. Well, I was aiming for a shorter video, but I just want to go through a couple of charts now to try to finish off the story. So like I said, the first thing I need to see for us to show that we are going to potentially go higher is we have to stabilize and print a daily higher high. That has not been done since the day we heard from the Fed. So high, lower high, lower high, lower high, lower high, lower high, and lower low. So, right, every single day has been a lower low. Every single day has been a lower high. What does that mean? We're pointing down. The path of least resistance right now is lower. And that's evident on the hourly chart. It's actually accelerating. So before we can go back up, we have to start going flat. We have to print a daily higher low and a higher high. Then we can actually start going back up. So until then, the best place to be is on the sideline, waiting. This is not advisable to short right here, right now. I also don't think it's really the area to try to be catching knives. So now moving forward to QQQ, we can note here that, right, we're now at new yearly lows. We got a huge push in volume, and this does not really look like it wants to settle here. If we close out here on Friday, we're closing out just like SPY at the low of the week, which means we're building up pressure to the downside. And that exact same area on SPY at 428 is where we're finding strong sellers on QQQ at roughly 324. That's where we have that negative 20% off the high. So need to see that same thing on QQQ here. On a daily time frame, we're noticing that same pattern, right? Yesterday we staged a higher low inside bar, and then we broke it. Lower high, lower low. Only the one day we didn't print a lower low. Now it's resuming lower, and it's accelerating. Look at those big fat red bars, right? That's big volume. Hard to ignore it. As we move forward, the dollar's at 104, VIX is above 30, TNX is below 3, so we're going to skip all those because we're not really doing all that much. Oil rocked up 6% today, though. Yeesh, back above its 50 MA, and it's looking pretty bullish, not going to lie. It looks like it wants to go higher, which is going to add even more pressure to the inflation narrative. Looking over here to ETH is now even going below 2. There's now concerns like seeing the UST, which is now, again, it's supposed to be a stable coin. It lost 40% of its value today. So now the question is this crypto thing even legitimate? Is it going to even hold up? BTC lost 30K. ETH is about to lose 2,000. It's been waterfalling all day. It's down 13% right now, right? Definitely going risk off. Looking at our weekly charts here for these big stocks, our leaders, well, Apple's kind of leading to the downside now. Huge pivot off of 147, which is our previous top in our 50 MA. Not a nice chart. Not enough volume to say this is a flush out either. Microsoft, right? Lost its lower trend line. Even more bearish. Even in a head and shoulders, not bearish enough. Google throttling that lower trend line. And I think that Google is just being held up because of travel. I'm not sure it's going to be able, and it's sold off ahead of the others too, to be fair. And they're doing a buyback. So I don't know. I think Google is going to continue lower. I don't see how it's going to hold up here. But again, it's the better alternative versus the others right now. Amazon, right? Oh, man, it's almost all the way down in that pocket now. Almost down to 2,000. Yep. And that takes us all the way back down here to 2018 highs. Yikes. Tesla. Ooh, right? Elon Musk. He's pretty lucky he got to sell. Even if he doesn't buy Twitter, I'm sure he's pretty happy. He actually has some realized cash right now. He's no longer paperish. He's realized it. Stock doesn't look all that much better. It looks almost like Apple, rejecting off the 50 MA. Right here, and then also rejecting off the 2021 high. So Tesla looks just like Tesla. Apple looks just like Tesla. They both want to go lower. Facebook, not red enough. Right, down another 4.5% today, down to 188. And Facebook is looking pretty cheap here. It's trading at a 14 PE. Whoa, right, that's pretty cheap for a couple $100 billion company. Yep. NVDA, oh baby, it's getting redder. Woof, right, this is looking pretty bleak. Down 5% on the day, right at a new low, and retesting roughly our highs from April of 2021, sorry. In terms of the other ETFs, what I want to focus on is going to be Arkk and IWM. So, oh man, I didn't look at this until right now. So those previous tops I was looking at from 2018 and 2020 were supposed to be support. It does not look like it's holding up. Yesterday was a support or the dead cat bounce. We rejected off the 200 MA on the weekly, and now we're right back here to a fresh low. If we close out here on the weekly, for me, that is opening up the window for an additional cut. We have a gap to fill here at 165.71. And it's also important to note that this is likely going to be a very high volume week. Why? It's only Wednesday. We're already matching last week's volume. Oh, man, that's not looking good. And then looking at Arkk. Lots of people are out there, right, talking smack about Arkk, including Jim Cramer. I don't want to talk about it. I'm here to talk about the charts. Again, looking at the weekly chart here, we're now even below my target. I was looking for 37.55. We close in the 36s. Oh, geez. And this doesn't look all that great. On the volume, we've already traded almost as much volume as last week, too, just like the Russell. People are folding. They're running for the hills. So if you want to see my deeper review, including 2022 bear market targets for 2.0, I encourage you to watch the video that I'll queue up here in a moment. Otherwise, it is best to opt for safety. Right now, the market is not providing a whole bunch of relief. And for us to have a meaningful reversal, not just a dead cat bounce, there's going to need to be a lot of work done. I think that we're closer to a relative bottom than we are to a relative high, but nothing is safe out there right now. So with that said, I wish you all the best of luck, and I look forward to seeing you tomorrow.